Okay, we're about 15 minutes away from the start of trading, and generally speaking, investors in a reasonably upbeat mood this morning, partly tied to earnings. But on the economy, particularly in the United States, kind of a challenging series of data points this morning. Growth cooling, inflation still high. The GDP report in the United States showing a cool down in the first quarter, and yet on the inflation front, we got some data today reminding us that that is going to be a challenge for the Fed. And let's get some perspective now from a former Fed official, Carl Tannenbaum, who is chief economist at Northern Trust. Carl, thanks very much for being with us. Great to have you back. And, you know, this is the tricky thing that everyone's been wondering about. You keep seeing signs that maybe things are cooling down. The inflation story, though, it's hard to know when we get back down to more normal levels. What's your takeaway on where we're at based on the data we've got?
Well, to be honest with you, compared to where we were in the middle of last year after 2 quarters where GDP had dropped, I think we're in much better position. The second half of last year was strong. The first quarter numbers released earlier this morning were, in fact, tepid. Reading into the details, inventory investment was a real drag on growth, taking about 2% off of the rate of real economic growth. That probably won't persist. I think the underlying strength of the economy is probably somewhere a little bit north of 1.5% or so, which is not bad given all of the shocks that we have endured. We're one of the few houses that does not think we're going to have a recession during the balance of the year. Growth will be slow, but that should be enough to start bringing the inflation rate down just a little bit. All of that said, I don't think that anybody is attesting that inflation is where it needs to be and is firmly headed to where it needs to go. As a result, when the Federal Reserve gets together next week, we are expecting one more 25 basis point hike.
And, you know, look, here in Canada, as you well know, the Bank of Canada has been on hold for a couple of meetings now, but we just got the meeting minutes from the previous meeting yesterday, where it was revealed that because of the inflation challenges, they did at least consider the idea of raising rates. So no central bank is sort of in an ideal scenario right now. I wonder as well, with that Fed decision next week, how closely you've been watching the banking turmoil. It felt, Carl, in the last few days, because everyone was wondering, what's going on with like First Republic? Is this Silicon Valley Bank Part 2? Does that turmoil play into the idea that the Fed, at the very least, after that, expected 25 basis point hike, has to at least take a pause here, just for fear of breaking too much in the economy?
Banking stress barreled its way into the Fed decision room in March. The issues related to SVB, First Republic, Signature Bank, were all very proximate at that time. My understanding is that the Fed could have gone either way, and the decision to raise rates in March was reached only at the very last minute when they became satisfied that the problems were contained. I'm not sure that diagnosis needs to be changed. First Republic has been in the headlines this week. It is not a new situation. The signs are that it has not yet carried over to any other significant financial institutions. And so I don't know that banking stress is going to be a significant ingredient in the decision that they're going to take next week.
Interesting. So just real quickly before we let you go, raising rates is your expectation by 25 basis points next week. Do they then signal that they are done with rate hikes, or do they just sort of say we're going to take a wait and see approach from here?
I think a wait and see approach is appropriate. We think that they're going to stay on hold for a long time in order to make sure inflation is under control. They're going to have to steer the markets, though, because the market is expecting lots of cuts during the balance of 2023.